Welcome after the break. It's counting down to the end of financial year, and what you want to hear is tax saving. Yes, we have got the answer for you. One of the strategy which is applied to save tax is loss harvesting. What is it? How does it work? We have our in-house expert Anurag Shah, who is going to break it down for you how you can actually apply this strategy. Anurag, take it away.
So till 31st March midnight, there will be a lot of permutation and combination to save tax, and one strategy can be very much helpful, which is loss harvesting. So in loss harvesting strategy, you just have to sell your mutual fund, your stocks, and buy it again. It locks your capital gain. Your capital gain losses can be carry forward. It is applicable for real estate, mutual fund, stocks, and your losses can be carry forward up till 8 years. So how it works? So in equity market, there are 4 types of profits which investor or trader will make. One is from F&O, one is from intraday trading, one is short-term capital gain, and the last one is long-term capital gain. So as per the income tax rule, loss adjustment and carry forward, if during a year, short-term capital loss is there, it can be adjusted against the short-term and long-term capital gain. So any short-term gain or long-term gain will be adjusted against the short-term capital loss. But if there is a long-term loss, it can get adjusted against only long-term capital gain. So during a year, whatever loss you have seen in your long-term capital loss, it will get adjusted against the long-term capital gain only, and the losses can be carry forwarded for 8 years. Similarly, F&O income, F&O losses or F&O gains can get adjusted with it's considered as a business income only. Other than the salary income, F&O losses can be adjusted against the business income. Like somebody is working as a contractual consultant, though his income can be set off against any F&O losses he has occurred during the year. The final one is speculative income, which is intraday profit. So if you're buying shares in morning and selling by afternoon, that income is a speculative income, and that cannot be set off against any term. It can be set off against the speculative profit only, and it can be forwarded for 4 years. So through an example, I will tell you how a tax liability of 2.7 lakh can become zero. If somebody is having, it's an example, if somebody is having a portfolio of 60 lakh at the starting of a year, and when markets were high till September 2024, and he made a good gains and booked a profit of 16.25 lakh from his portfolio because markets were high, and in that 16.25 lakh profits, 12 lakh was of short-term capital gain and 4.25 lakh was of profit booked under the long term. So after when we saw in January, in February, markets fall, there were unrealized losses were there. So you just need to sell 15 lakh of shares from your portfolio. So due after this, your total tax due of 2,77,000 will be nil. So 15 lakh of loss will be there. So that 15 lakh of loss will be set off against the 12 lakh of short-term capital gain and 3 lakh of LTCG, and 1.25 lakh is the tax-free limit for long-term capital gain. So by tax harvesting strategy, you can make your tax liability, which was 2.7 lakh rupees, to zero.
If you like this video, then like, share and subscribe to ET Now.